Hello, this is Japanese Economic Review Channel. This time, let's take a look at SBI Securities' domestic weekly outlook.
Sounds great. I mean, there is just a massive amount to unpack this week.
There really is. Imagine a world where the entire global economy is just, holding its breath over the earnings report of one single microchip company.
It sounds a bit crazy when you say it out loud, but, well, you don't really have to imagine it because that is exactly where we find ourselves this week.
Welcome to the broadcast, everyone. If you are joining us, think of this deep dive as your essential shortcut to understanding all these complex market forces at play right now.
Right, because beneath the surface of these record market highs we are seeing, there are some really intense cross-currents.
Exactly. So we are strictly dividing today's mission into three core segments. First, we will look at this week's stock market outlook. Second, notable materials and foreign exchange. And third, we are going to map out the weekly timetable.
That is a perfect roadmap. There is definitely a lot of ground to cover.
So let's jump straight into segment one, this week's stock market outlook. The big picture here is just the relentless momentum of the Nikkei average.
Yeah, it has been a truly remarkable run.
I mean, it continued hitting record highs even as the corporate earnings season basically reached its peak.
Right, but to understand why the Nikkei is defying gravity like this, we have to look at the engine driving it. It's not just blind optimism.
So what is the fuel then?
The primary fuel is this massive capital expenditure boom surrounding AI infrastructure. We're seeing incredibly strong corporate earnings guidance, especially from companies involved in data center equipment.
Okay, can you break that mechanism down a bit? Like, how does building data centers directly translate to these specific stock surges?
Sure, think of it like building the electrical grid for a completely new industrial revolution. Tech giants aren't just buying AI software.
Right, they are building the physical stuff.
Exactly. They are physically building massive, power-hungry data centers to process all that AI. And that requires specialized semiconductors, advanced cooling systems, massive power transformers.
So Japanese companies that supply those hardware components are just seeing a tidal wave of orders.
You got it. And on top of that physical demand, the market also just breathed a huge sigh of relief over geopolitics recently.
Right, the situation involving Iran didn't escalate to the degree people feared.
Yeah, and there are growing expectations of stable relations between the U.S. and China following some recent diplomatic engagements.
Okay, well, I have to push back here for a second.
Sure, go ahead.
If the data center demand is a sure thing, and these geopolitical tensions are easing, why does the SBI Securities report specifically warn us to brace for high-priced stock volatility?
That is the million-dollar question.
It just feels like a glaring contradiction. I was looking at the current AI market and, well, it feels exactly like a highly anticipated movie sequel to me.
A movie sequel. Okay, I am curious where you are going with this.
Just think about the biggest blockbuster franchise you can imagine. When the next movie comes out, the expectations are just so astronomical.
Oh, I see.
Right. So even if the movie is objectively really good, it might still disappoint the diehard fans and face a huge backlash. The hype just creates an impossibly high hurdle.
That is actually a brilliant way to understand the NVIDIA factor right now.
Really?
Yeah. NVIDIA is essentially the lead actor in this whole AI blockbuster. Their earnings are coming up early morning on May 21st, Japan time. And the hurdles for their sales and forward-looking guidance are just astronomical.
And the report points to some leading indicators for this, right? Like Taiwan Semiconductor Manufacturing Company or TSMC.
Correct. TSMC actually manufactures the physical chips that NVIDIA designs. Based on TSMC's recent monthly sales, which were stellar, NVIDIA might easily clear those massive hurdles.
But there's a catch.
Always. And this is where your movie analogy holds up perfectly. Historical trends show that even if NVIDIA absolutely blows past expectations, U.S. tech stocks might still face a massive sell-off.
Because the market has already priced in perfection, right? It's that classic buy the rumor, sell the news mechanic.
Exactly. When everyone assumes the news will be spectacular, they buy in advance.
So once the spectacular news actually arrives, there's no one left to buy.
Right. So early investors just take their profits and sell, which drives the price down.
That makes total sense, which actually brings up a really fascinating metric from the report that shows just how distorted this tech rally has become, the NT ratio.
The Nikkei to 2px ratio. Yes, this is a crucial indicator right now.
For those listening who might not look at the underlying math of these indexes, let's break it down really quick. The Nikkei 225 is a price-weighted index.
Right, meaning a company with a very high share price has a disproportionate pull on the whole index.
Exactly, often these big tech and export companies. But the 2PX is market capitalization weighted, meaning it tracks all the major companies on the exchange. It gives a much broader picture of the everyday Japanese economy.
And after the Golden Week holidays, the NT ratio spiked to a highly unusual 16.3 times.
Wow, what does that actually look like in practice?
Well, imagine a massive marathon. The Tuparkbix represents the tens of thousands of runners just jogging at a steady, normal pace.
Okay.
The Mickey represents a tiny handful of elite sprinters who have suddenly rocketed miles ahead of the pack.
I see.
That 16.3 times ratio means the tech-heavy Nikkei was vastly outperforming the broader market. Capital was just crowding into a very narrow band of AI and semiconductor stocks.
Well, the rest of the domestic economy was basically just moving sideways.
Exactly.
But the fever seems to be breaking, right?
Yeah.
The report notes that by the 15th, the NT ratio dropped back below 16 times.
Which is a very healthy signal. If a market is only held up by a few sprinters, it is incredibly fragile.
Right.
We saw the Nikkei hit an intraday high of 63,799 yen on the 14th before turning downward, while the TOPIX remained relatively stable.
So that drop in the ratio means the extreme overheating in the tech sector is finally cooling off.
Yeah, and capital is distributing a bit more evenly.
Summarizing the SBI outlook, the expected range for the Nikkei this week is forecast between 58,500 and 63,500 yen.
So we are looking at a very wide, elevated channel.
Right. But here's the thing about high-flying tech stocks. They are incredibly vulnerable to macro gravity. And in the financial world, gravity is interest rates.
That is a perfect transition into segment 2, because high long-term interest rates actively compress the valuations of high-growth tech companies.
Let's explain why that is for a second.
Yeah.
If I am an investor, I value a tech company based on the massive profits I expect it to make 10 years from now, right?
Right.
But if safe government bonds are suddenly paying a high interest rate today, the relative value of those risky future tech profits goes down.
Precisely. The mathematical term for that is the discount rate. Higher interest rates increase the discount rate, which basically shrinks future cash flows mathematically.
And that brings us to the most volatile battleground we are watching this week: the currency markets, foreign exchange, and the inflation monster that dictates those interest rates.
It is a messy battleground right now.
Setting the stage here, the report outlines an expected range for the US dollar to Japanese yen at 156.50 to 160.50 yen.
That is a wide range.
It is. Let's walk through the chronology of how we got trapped in this corridor, because the week of May 11th to the 14th was highly instructive.
It was essentially a masterclass in how sensitive the yen is to both sudden geopolitical shocks and slow-burn macroeconomic data.
Let's start with a geopolitical shock on May 11th. Former U.S. President Trump made comments rejecting the Iran peace plan, calling the Iranian response completely unacceptable.
Right.
Now, a quick pause for our listeners here. We must explicitly state that we are maintaining strict political neutrality on this deep dive.
Absolutely.
We are not endorsing any political platform, taking sides on Trump's comments, or weighing in on the Middle East conflict. We are strictly analyzing the raw mechanical reaction of the foreign exchange market to a geopolitical news event, as detailed in the SBI Securities report.
Understood. And purely from a market mechanics perspective, those comments triggered what the report calls emergency dollar buying.
Walk us through the psychology of that. Why does tension in the Middle East make people suddenly rush to buy U.S. dollars?
It mostly comes down to the fear of energy disruptions. If the Middle East destabilizes, oil supplies are threatened.
Right, which scares global capital.
Exactly. When global capital gets scared, it immediately looks for a bunker to hide in. And the ultimate financial bunker is the U.S. dollar, because it is backed by the U.S. Treasury.
So investors sell riskier assets and buy dollars for safety.
Yes. So the dollar strengthened against the yen, entirely based on that risk aversion.
Then we get to May 12th and 13th, where the macroeconomic data basically takes over. We had a U.S.-Japan finance ministers meeting that didn't produce much action.
But then the U.S. released its CPI and PPI data.
The consumer price index and the producer price index. And both of them came in hotter, meaning higher than economists expected.
Right.
Now, I want to voice something that might confuse some listeners. If consumer spending and producer prices are high, doesn't that mean the U.S. economy is booming? Why did that data crush early hopes for a rate cut and cause the dollar to surge?
It is a great question. You really have to look at it through the lens of the central bank. The Federal Reserve's primary job right now is to kill inflation, Okay. When consumer prices and wholesale producer prices are running hot, it means inflation is sticky. It refuses to die down.
So the Fed has to keep its weapon, meaning high interest rates deployed for longer.
Exactly.
Hmm.
And here is where it hits the currency market, the yield differential.
Right, the gap between the two countries.
Yeah. If U.S. interest rates stay high, say around 5%, and Japanese interest rates stay near zero, global investors will naturally take their money out of Japan.
Because they want to move it to the U.S. to capture that 5% return.
Exactly. And to do that, they have to sell yen and buy dollars. That constant selling pressure naturally weakens the yen.
That makes total sense. So the dollar is flexing. Then we hit May 14th, and we get a brief glimmer of hope for the yen.
Right. Bank of Japan board member Masuichi gives a speech that the market interprets as hawkish.
For those unfamiliar with central bank terminology, a hawk wants to fight inflation by raising interest rates and tightening the money supply.
While a dove wants to stimulate the economy by lowering rates.
So a hawkish speech implies the BOJ might raise rates sooner rather than later?
Yeah, and that caused a brief spike in the yen's value. But it was incredibly short-lived.
Why is that?
Because almost immediately after, the U.S. released its retail sales data, which showed really robust consumer spending. And that U.S. data just completely overpowered the BOJ speech.
It goes right back to that yield differential.
Exactly. The market looked at strong U.S. retail sales and concluded that the U.S. consumer is too strong, U.S. inflation isn't going anywhere, so U.S. rates will stay high.
The massive gravity of the U.S. economy just pulled the dollar right back up.
It really did.
And the threat of inflation isn't just about consumer spending. The report notes that the emergency dollar buying we saw earlier, tied to those Middle East tensions, keeps global oil prices high.
Right.
And high oil prices make transporting every good on the planet more expensive, which feeds right back into that sticky U.S. inflation.
It is a vicious feedback loop. And market sentiment has shifted so drastically that investors aren't just giving up on rate cuts anymore.
Wait, really?
Yeah, there are now serious whispers about a potential FRB rate hike within the year.
Wow. A hike would send absolute shockwaves through the system. And speaking of the Federal Reserve Board, we have a massive variable approaching.
You do?
The report highlights that Jerome Powell's term as Fed chair expires on May 15th, and Kevin Warsh is expected to take over. Now, Warsh is seen as having close ties to Trump.
Right, which introduces a profound uncertainty.
Will a new chair lean toward financial easing to stimulate the economy or hold the line against inflation? And again, just keeping our political neutrality intact here, we are just looking at how the market prices in this anxiety over central bank independence.
Exactly. Because markets can handle bad news, but they absolutely despise uncertainty. The transition at the FRB means every single policy statement will be heavily scrutinized going forward.
But let's bring it back home for a second. Japan has its own internal drama compounding the yen's weakness.
Yes, it does. As we saw with board member Masuichi, early rate hike speculation is growing in Japan.
But complicating the BOJ's job are the rumors of a massive 2026 government supplementary budget.
Right.
A supplementary budget means the government wants to spend more money than it currently has. So how do they fund that, and why does it spook the market so much?
Well, they fund it by issuing more Japanese government bonds, or JGBs. If the government floods the market with a massive new supply of bonds, the basic law of supply and demand kicks in.
Meaning the price of those bonds drops.
Exactly. And here's the crucial mechanic. Bond prices and bond yields move in opposite directions. When the price of a bond drops, its yield, or long-term interest rate, surges.
Ah, I see.
So you have Japanese long-term rates surging due to both BOJ hike speculation and the fear of fiscal deterioration from government debt.
Which locks us into the chart reality we discussed earlier. The 160 yen to the dollar mark is the absolute ceiling.
Right. That is the invisible line where the market genuinely fears direct intervention by the Ministry of Finance.
Where Tokyo just steps in to aggressively buy yen, and the mid-156 yen level is acting as the floor where recent drops have stabilized.
We are just trapped in that high-stakes corridor, constantly pushed and pulled by the interest rate gap.
So we know the macro forces at play. We know the mechanisms of the AI boom, the discount rate, and the yield differential. The real question for anyone managing a portfolio right now is, when exactly are these landmines going to detonate this week?
Right, let's take all this theory and map it onto the actual calendar.
Segment 3, our weekly timetable.
This is where we operationalize all that data. We are going day by day through the key events that have the power to move markets.
Starting with Monday, May 18th. At 11:00 a.m. Japan time, China releases its April industrial production and retail sales.
China's basically the manufacturing floor of the world. Those numbers give us a vital read on the raw health of the Asian economic engine.
And then, late at night for us, at 23.0, the U.S. releases the NAHB Housing Market Index. Why do we care about a housing index so much?
Because housing is the sector most acutely sensitive to interest rates.
Yeah,
Most people need a mortgage to buy a house, you know?
right.
If rates are too high, mortgage applications plummet, builders stop building, and economic activity slows down. It acts as an early warning system for the broader U.S. economy.
Good to know. Moving to Tuesday, May 19th. At 8:50 a.m., Japan's Q1 GDP preliminary figures drop, followed at 13:30 by Japan's March industrial production and capacity utilization.
Let's actually explain capacity utilization real quick.
Please do.
Imagine a factory that can produce 100 cars a day. If they're only producing 70 cars, their capacity utilization is 70%.
Okay, simple enough.
If that number creeps up to 95% or 100%, it means factories are completely maxed out. To produce more, they have to hire more workers and build new factories.
Which drives up wages and costs, which ultimately drives up inflation.
Exactly.
Great explanation. Also on Tuesday, the International Board is active. At 10:30 a.m., Australia releases the RBA minutes.
Australia is a massive exporter of raw commodities, so their central bank outlook is a great proxy for global industrial growth.
And at 23.00, U.S. April pending home sales, checking that interest rate pressure again.
Which brings us to Wednesday, May 20th.
The Super Bowl of the week.
It really is. This is the day where two tectonic plates shift simultaneously.
Domestically, we have massive earnings reports from the insurance giants Tokyo Marine, MS&AD, and Sompo.
But the real earthquakes are overseas. First, the U.S. FOMC minutes.
Right.
The FOMC is the committee within the Federal Reserve that sets interest rates. These minutes are the detailed transcripts of their last meeting.
And the market watches these closely, right?
Oh, in modern finance, algorithms will literally scan the text of these minutes the millisecond they are released. They count how many times words like inflation or risk are used to gauge whether the Fed is leaning hawkish or dovish.
Unbelievable. And then the main event, NVIDIA earnings.
As we discussed earlier, this is the referendum on the entire AI infrastructure boom. If NVIDIA shows any sign of weakness, the shockwave will hit those Nikkei sprinters we talked about.
And probably ripple through every major index globally.
Without a doubt.
So if you were trading, Wednesday is definitely not a day to step away from your screens. Moving to Thursday, May 21st, Japan's April trade statistics and March machinery orders hit at 8:50 a.m.
And then a massive U.S. data dump late at night. At 21:30 Japan time, the Philly Fed Manufacturing Index and housing starts. Then at 22.45, the U.S. May PMI, the Purchasing Managers Index.
PMI is fascinating because it is a true leading indicator, right?
Exactly. Before a factory can build a product, the purchasing manager has to actually order the raw materials. PMI surveys those managers.
So if they are buying lots of materials, it means they expect strong future demand.
Right. If the U.S. PMI comes in hot, it signals a robust economy, which feeds right back into the narrative that U.S. rates will stay high, likely pushing the dollar up again.
And finally, Friday, May 22nd. We close the week with the final boss for the Bank of Japan.
Yes.
At 8:30 a.m., Japan releases its April CPI, the Consumer Price Index.
This brings everything full circle. This is the exact number that dictates BOJ policy.
Right.
If Japan's inflation is running hotter than expected, the pressure on the BOJ to raise rates intensifies. That could spark a surge in Japanese long-term bond yields and finally give the yen some strength against the dollar.
And at 23.00 on Friday, the U.S. releases the preliminary May Michigan Consumer Sentiment Index.
Which is basically a reading on how confident everyday Americans feel about their wallets.
And that ultimately drives 70% of the U.S. economy. It is an incredibly dense, high-stakes week.
It really is. We have mapped out the mechanics of the AI stock boom, the yield differentials driving the currency markets, and the specific data points that will trigger the next moves.
It is a lot to process.
Yeah.
But looking at the whole board from NVIDIA's earnings to the transition at the Federal Reserve, it raises a pretty profound question for anyone navigating these markets today.
It does. You know, when global financial stability seems to hinge almost entirely on the quarterly revenue of one single microchip company.
Right, NVIDIA.
Yeah, and the appointment of one single central bank chair. We really have to ask ourselves something.
What's that?
Are modern markets actually reflecting the health of the broader global economy anymore? Or have they simply become highly leveraged bets, resting entirely on a handful of isolated choke points?
Oh, wow. That is a phenomenal thought to leave you with. A massive complex system resting on a surprisingly narrow foundation. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.